Welcome to module 4 of week 1, and today we are diving into understanding leverage, margin and lot sizes. I hope the past 3 modules have been good for you and you've gone over them as often as you can. So right now let's get straight into business. So today what we are going to be looking at is going to help you to know how you can trade more than what you have in your account. You know, we said the Forex industry has a lot of money in it, like about $7 trillion flows every day. And you'll be wondering, how is your $100, how is your 1K, how is your 5K going to do anything? But here is how we are going to understand some of the concepts that comes along with you being a Forex trader. Every time you execute a trade, what goes on, and when you try to execute and the trade is not being executed, what might have happened at the back end. So we are talking about leverage, margin and lot sizes. These three keys are what makes Forex trading so powerful and also risky, because as we go in the lesson, you're going to understand that when you have a big lot size will mean big money, and when the market turns against you, it also means big losses, right? So you understand how they work at the end of this session. So let's get into it. So the number one thing is leverage, and let's put a ring to it. You know, I like to put that, call it the power multiplier. So imagine you want to buy a cow. Cow. Let's say you have a wedding ceremony or something, and you get to the market but you don't have enough money to buy it. Then the person selling the cow will be like, don't worry, how much do you have? Bring the small money as a down payment, or they offer to lend you more money to be able to buy the cow. That's exactly what leverage means. And you know, in real life we use this word leverage as advantage, right? Or an edge or an additional advantage. So that is exactly what it means as well in Forex. We are going to go through this progression of lesson from bottom to top. When we get to the third point, you would understand the first one better, but I need to lay the foundations like this. All right, so let's define leverage. Leverage allows you to control a large trade size with a small account of your own money. So how does it work? The broker, remember broker, right, from yesterday? So the broker is the one that provides the leverage. Usually you will see it written when you're about to sign up to a broker account or on a brokerage. You are going to see 1 to 100, 1 to 50, 1 to 1000, 1 to 500, depending on what the broker is offering. That's the leverage. And what that means, let's take example of the 1:100. What it means is that when you deposit $100 in your account, they will let you control trade in the market that is up to like $10,000. Yes, don't worry, you understand. It doesn't mean you have $10,000 to withdraw, but it means that you can use that leverage. You can leverage the 100 as though you are playing in a field that is 10,000, right? You will understand better as we go forward. Just take note of leverage. When you see these things in the field, I mean on a practical account, you are going to understand them even further. So why is it useful? Because it amplifies a trader's power. There was a time I was trading on a brokerage that has the leverage of 1 to 50. That is very small. So anytime I try to do what we call over leveraging, meaning executing or putting in positions that are more than your account, that could easily blow your account, right? The brokerage did not allow the trade to execute, so they reduced my power because my account was small, to protect me. Some brokers will not even care to protect you. They will give you big leverage. You put $50 in an account, you can open 10 positions, and if it goes against you by just 2 pips, the account is gone. Yes, that's what over leverage could do. You'll have been seeing traders on social media doing what they call flipping of accounts. Basically, most of them are over leveraging, which might be a bad habit. For a skilled trader, they could do that, but for us in this course and going from this level, we are not going to indulge in over leveraging. We use the proper leverage for the proper size account. All right. So why is it risky? Just as it simplifies profit, or rather amplifies profit, it also magnifies losses, because when it goes against you, the same rate that it should give you profit is the same rate that it should give you the negative. So let's say you enter a big lot size, you over leverage $100 account. You are supposed to use, I'll get to lot sizes, you're supposed to use a small lot size, use a bigger one than the account size that you have. If it goes in profit for just like 5 pips, maybe the big lot size you have, or your $100 per pip, can just be giving you like $30, $30. You are happy that your $100 is giving you profit like ASAP, right? But if it goes against you, imagine what will happen to your heart will be racing, right? So this leverage, even though it amplifies profits, it also magnifies losses. If you don't manage risk, you could lose more than you intend to. Remember, I think the last lesson, I was telling you about what we are trying to do is to reduce, we are able to calculate what we can lose and what we can make, and we make peace with that. Oh, on this trade, I'm losing, with the opportunity that I've seen, I'm willing to lose $30 to make $90. That's a ratio 1 to 3. So we have admitted the risk when we enter the trade. My account is $1,000. On this trade, I'm willing to lose 30. I execute my trade and give myself peace of mind. If it takes my $30, I'm done for that day. I'm not trading anymore. I will come and check another session to see another opportunity set up for me. That is how we manage risk when it comes to Forex trading. And leverage is one of the things that we put into consideration. Moving on to number 2, which is the margin, your security deposit. You can look at this as the deposit that you give a landlord when renting a house. It's a small portion of the total trade value that you set aside to open a position, right? So listen to this definition. Margin is the money required in your account to open a leveraged trade. Remember what leverage is on number 1, right? So you have to have some certain amount of money before you can even try to put small out of that big money to play in a trade. Do you understand? So for example, if a broker requires 1% margin and you are trading 10,000, you need what? You need $100 in your account as a deposit. So we already said that the broker is going to give you leverage to trade bigger than what your account looks like, right? So when you deposit $100 and the leverage from the broker is 1 to 100, right? What the broker is telling you is that, oh, I can let you play in a trade that is up to $10,000. So the margin is 1%. So when you have $100 in your account, you can be able to place some certain trade. The next lesson, which is lot size, is going to bring a light to this 3, because we're going to marry them together. All right. But the key point from this number 2 that you need to hold on to is that margin is not a fee, unlike the spread that we spoke on, right? The spread that we spoke on, margin is not a fee. It's simply a set aside by your broker as a guarantee that you can cover a potential losses, right? So if the trade is now going against you, there is something we call the margin call. You're going to get to that later. When your broker sees that the trade is going against you too much and you probably didn't set your stop loss, the stop loss is the automation that takes you out of the market when the market is going against your direction at a certain price, right? So when your broker sees that, oh, this guy didn't set stop loss and the account, the $100 is almost finishing, they will not leave the trade and you have minus 105. No, what was in your account was $100. It's not even get to that 100 before it closes your position and say you have a margin call. Let's move on to the next one, because this is what is going to bring the light to the leverage and to the margin. So lot sizes is the building block of trade. Lot sizes, building blocks of trade. Now let's talk about the size of trade. In Forex, trades are measured in lot sizes. Now, the last time I mentioned measurement was in the last episode about pips. Remember that pips is the measurement of the price, right? Lot sizes is the measurement of the trade. Right? Lot sizes is the measurement of the trade. And we have three categories for this majorly. We have the standard lot, we have the mini lot, and we have the micro lot. The standard lot is 100,000 units of the base currency. Remember base currency, right? All right. Base currency is the first one in a quote. Okay. Now, mini lot is 10,000 units, and micro lot is 1 unit. So on that micro lot, we are going, when we execute in our trading app, it is 0.01 lot size. The mini lot, which is 10,000, is 0.1 lot size, and the standard lot, which is 100,000, is 1.0 lot size. So let me give you an example. If you are trading Euro USD, you guys remember Euro USD, right? So if you are trading Euro USD and you open a 1 standard lot size, that is a 1.0, it means that you are controlling 100,000 euro. Why? Because the lot size is the what? Is the unit of the base currency. That means you are executing at 100,000 euros. And if it is a micro lot, that means you are controlling 1,000 euro. All right. Remember, micro lot is the last one. We have micro, mini, and standard. So why does this matter? The lot size determines how much each pip movement is worth, which affects your potential profit and loss. So when we get into pip calculation, when the pip goes by 5 pips on Euro USD, how do we know how much money that is? Although you don't need to do the mathematics, on any trading app, it's going to show how much that is when the market starts to move, right? But let's tie it all together, right? Number one thing is that you choose a lot size to decide the trade's value, whether a standard lot, whether a mini or a micro. That's whether 0.01 or 0.1 or 1.0. Mind you, in between those figures, you could have other numbers, but just for the purpose of education, and when we get into risk management, we'll talk about that more. It could be 0.02, 0.03 for the micro, right? But let's just choose 111 all through. So you choose the lot size to decide the trade's value, and then your broker will calculate the margin required to open the trade for you. Then the leverage allows you to control the entire trade size with just the margin. So example in action is that you trade $100 in your account and 1-to-1 leverage, 1-to-100 leverage. If that is what was on the leverage, then you choose a lot size. Say you choose the mini lot size, which is 10,000 units, or just one of that, 0.1. The required margin, because you have 1-to-100, is now 1% or $100. So you are controlling 10,000 in the trade. Now, why you as a beginner needs to be conscious, or courteous rather, is this lesson that we just went through. You need to pay a lot of attention to it. If you don't understand it better, I will try to explain it further in a live session. Because while leverage and margin allow you to trade larger amounts, they can also drain your account quickly if the trade moves against you, right? As much as maybe you have friends that trade cryptocurrency, or you know about cryptocurrency, they say they are using 10x, 20x, and maybe they already want them to use 1x, and then they use over leverage. Over leveraging will send you back to your village in no time. I have that quote behind my mind every time. So key tips from this session is that as a starter, you need to use small lot size. In fact, you have $100 account, the lot size you are allowed to even think of using is 0.01. You are safe. Although on pairs like Euro USD, when you use 0.01 and the market gives you 10 pip movements, whether up or down, if it's going down and it sells for 10 pips, your 0.01 will be giving you about, I think, is it $10 or $1? or thereabout. I think 10 pips is $1. It's quite small, right? I understand. But that is why, okay, when you now deposit like $1,000, you could use 0.1 lot size. So when the market moves, it gives you the multipliers. You understand? So, but risk management is very important. Number two, always calculate your risk before opening a trade. Just like I said earlier in this session, when you are opening a trade, you know, oh, I'm about to, if the market goes to this place, I'm about to lose $30. But if it goes all the way as I predicted that it should go, or analyzed that it should go, then I'm going to make $100. Then you ask yourself, can I take that risk? Yes, I can. I have 1,000. If I lose 30 today, it's fine. It's not a marathon. I'm not trying to buy a Lamborghini from my $1,000 account anyways. Click that trade, buy or sell, execute, and let's go. Right? So number three, think of leverage as a tool, not a shortcut to success. Right? Some are looking for brokers that will give them leverage of 1 to 1,000 so that on a $100 account they can use one lot size. Really? Like, really? That shouldn't happen to you as a beginner. So these things helps you to put risk in check, because it is almost inevitable to lose money, but they can be calculated risk. That is the beauty of forex trading. All right, so it's that's it for today. We have spoken about leverage, margin, and lot sizes, and why they are critical in forex trading. Tomorrow, what we are going to be doing is a little bit of practical. Somebody should be excited. We are going to be introducing you to trading platform, the most popular one in the whole world, MetaTrader, and show you how to start practicing everything you've learned this week. Because I believe if we don't do that, we might forget what we have learned, and what's the purpose of you taking your time to do this and me taking my time as well. Remember, forex is like a double-edged sword. It's powerful, but you need to use it wisely. Keep learning, stay disciplined, and let's keep you going strong. Until next episode, I'll see you. Cheers.